Hello everyone. Welcome to the second video for chapter 13, the corporations chapter, all about stocks, where Smart Touch Learning magically became a corporation. They're incorporated now. And they went from a service business to a merchandising business. They're still that, but now they're also a corporation and they're going to sell stock, both common and preferred. So, we went over briefly the highlights. It's hard to do it briefly because it's kind of a long, meaty chapter again. I warned you that the next couple of chapters are that, unfortunately. But what I did to save some time so you wouldn't have to watch me write, and also so I could write neater, I put this on the floor and did it. I wrote out the whole problem and I'm going to explain it step by step, just to save you from watching me scribble. Okay. And also it came out a lot neater, so I think that might be a plan from now on. Okay, so this problem is on page 735. It's problem 13-42A. Now, this is very much like the lab problem that you have, number 41A. And the last video I'm going to do is just like the second lab problem that you have, which I believe is 43A. For us, it's 50B that I'm going to show you tonight. But they really mirror what you have to do in the two lab problems, so I'm hoping it's very helpful. So this one, again, is about Dearborn Manufacturing, and it's not terribly long as far as the journal entries, but they pack a lot in there. A lot of the concepts in the chapter, and that's another reason why I like it. And I assigned one just like it for you to actually do. So this is 2018 transactions. So we start with January 16th, and they declared a cash dividend on that day of 6% on the 103 par value preferred stock, non-cumulative, which means that if they skip a year in declaring dividends, they don't have to make it up to you if you have non-cumulative preferred. Remember, the difference between preferred and common is preferred gets paid first before common, and if there's no money left, common doesn't get any, okay? That's why they call it preferred, and it costs more. Not all corporations have preferred stock, probably, I would say in the 40% range. Okay, so they also declared a 20-cent per share dividend on 100,000 shares of their $2 par value common stock outstanding. Remember, when you declare dividends, you always have to know the number of shares outstanding. So they're telling us here, which is great. Okay, but if you don't know, you would have to go back and see what was bought and sold and see what you have. You always have to know because you base it on the number of shares outstanding. The date of record is the 31st and the payment date is the 15th. Well, we know we don't need a journal entry for the date of record, but we do need a journal entry for the date of declaration and the date of payment. Date of record, they always give it to you, probably 99% of the time. That's just the people that are going to get it. Like, who owns the stock that day? They're going to get it. They're going to get the cash dividend. Okay, this problem also has stock dividends in it too, so it has both. So here's the day they declared it becomes a liability of the corporation. So altogether it came to $26,489, but this is how it was figured out. Is the dividends payable for preferred? I abbreviated preferred and common because I have limited room here on my little easel. I wish it was an easel. It's not really, I have to tape it on. But anyway, 6% times 1,050 shares outstanding of preferred times 103 par is $64.89, goes to preferred, right? And then common is going to get 20 cents a share times 100,000 shares outstanding, so 20,000 goes to common. If there wasn't enough money, common would just get what was left. But in this case, they don't have that problem. So on the 15th, we're actually going to pay all the people that were recorded on, no, I already forgot that date. The 31st of January, notice we don't need a journal entry for the date of record, only the date of declaration and the date of payment. We're reversing the payables by debiting them. Here's the preferred that's going out, $64.89, and the common credit cash. Okay. So now we're up to August 15th, where there's a stock dividend. Okay, except, no, I'm sorry, I skipped the split. You do not need a journal entry, as I mentioned in the first video. When stocks split, it's usually a 2-for-1 split, but it could be 3 or 4-for-1. But in this case, it's 2. That's the most common. Even in reality, it's the most common. And what happens when a stock splits? It's worth exactly the same thing, but there's twice as many shares if it's a 2-for-1 split. In other words, it's going from 100,000 shares to 200,000 shares now outstanding. And the stock is worth half as much. Market value gets cut in half, par value gets cut in half. Okay, so it would be, it was, how many dollars a share was this? $2. So it's going to go down to $1, gets cut in half. Okay? So they split the stock. This usually happens when a stock gets too expensive. They're trying to bring more buyers into the marketplace, and it works like a charm. Pretty soon the stock price goes back up and everybody's got more shares of it. So it works out great for the corp and the shareholders. So we don't need an entry, but now we have 200,000 shares outstanding. So now we're on the 15th, we have stock dividends declared, and they declared a 30% dividend. Now this time they're not giving out money, they're giving out shares of stock. Okay? That's kind of in the second half of the chapter, after the cash dividends. So it's a $1 par, now instead of 2, times 200,000 shares, times 30%. That's $60,000 worth of stock they're giving away, right? 60,000 shares at $1 par. And common stock dividend distributable, I try to abbreviate because that's quite a long thing to write. And that's also 60,000. So you can't say payable, you have to say distributable because it's not money. Okay? So that happened in August. Now we skip to, oh no, I forgot one. Did I forget? I did. This is supposed to be July 30th. I can't, I'm saying, when did we distribute it? Okay. This is supposed to be 7/31, my apologies. And what happens is, I don't have space now to put that this got distributed. So what I'm gonna do, I see a little spot here. I'm gonna put 8/15, I'm sorry about that. Looks so nice too. But I did leave one out. This actually happened in July, and I'm saying, when did it get distributed? It's not there. It's because I forgot to put it. So this actually happened, the dividend, the stock dividend was declared in July, but it's being paid in August. So August 15th, we would have common stock distributable dividend. I'm gonna have to really squeeze this. And that was 60,000. We're reversing the liability. We're distributing the stock certificates. $60,000 worth, $1 par, so it's 60,000 shares. And credit common stock, I'm gonna put CS for short, at $1 par. Always, always credit your common and preferred stock at par value. Always, always, when it's going out. Okay, let's bring this over. Sorry I had to squeeze that in. Looks so good, what can I say? I missed one. So that's supposed to go with right after 7/31, okay? So we distributed the shares. So now there's not 200,000 outstanding anymore, there's 260,000 shares outstanding, which I put down here in my little T account. See how there was 100,000, there was a stock split on 6/10, and then on 8/15 they distributed 60,000 more. So that's the balance. We're gonna need that for this pot coming up. Okay, so that's good. So in October, they repurchased Treasury stock. And as we learned in the chapter, this is when the corporation buys back stock that they previously issued to the public. There are several reasons to do this. One might be they might need it for incentive or bonus for their employees. One might be they're trying to make the stock less dilutive, in other words, less shares in the marketplace. There are several reasons, but really the biggest reason is they hope they can resell it for more. Treasury stock is recorded at cost. It ignores par value. It's the only one. Right? We never pay dividends on Treasury stock. We record it at cost. It's called the cost method. Treasury stock is also contra equity. It increases on the debit side just like the dividends do. They're all contra equity. They increase on the debit side. Regular equity accounts increase on the credit side. The Treasury stock and the dividend accounts increase on the debit side. Okay, so we paid $8. That's our cost. We bought 1,000 shares back from the public. We own them again. That's $8,000 in cash. They have a pattern in every accounting book I ever saw that had this, and they all do. The first time they sell it at a profit, so they can show you what happens with that. And then the second time they sell it at a loss, so they can show you what happens with that. And this is no exception. You're going to see this in the homework and in the lab problem. So on the 8th of November, they sold some, and look at, they got $10 a share, which is $2 more than they paid. This is good. So 500 shares they sold for $5,000. Credit Treasury stock, notice it's at cost. Again, always the cost method for Treasury stock. Only one that ignores par. 500 shares, $4,000. We made some paid-in capital above what we paid. There's even a paid-in capital account for Treasury stock. 3, one for preferred, one for common, one for Treasury stock. So that's the $2 difference between the 10 and the 8 we paid. So we got $1,000 of paid-in capital. Right? And I put that right here, right, in my little T account. The last thing in this part 1 of this problem, in November, unfortunately, they sold 300 more shares, but they only got $4, which is half of what they paid for it. Now, they did this for a reason. They wanted to enforce the concept of what do you do when you don't have enough here to cover the deficit. First of all, when you sell for less, paid-in capital is going to come down because you got to grab all that extra money you need it. But it can't go below 0. Paid-in capital cannot be negative. So where do you go for the rest of the money? You have to take it out of RE, stands for retained earnings. So we need another $200 because we sold it. We had $1,000 in paid-in capital. That's totally gone. We only got $1,200. We need to make up $1,200 more. So we got to go to retained earnings and grab that $200 by debiting our retained earnings account. There's an example of this also that I talked about a little bit when we were going through the highlights. There's an example in the book, kind of at the end of this section. But I just thought this was a good one, and I think it's going to happen in the one that you guys are doing too, that you're going to have to grab from retained earnings. They also give you the ending balance of retained earnings, the end of December, because we're going to need it to do this, the stockholders' equity section of the balance sheet. So we debit our retained earnings. We've dumped out our paid-in capital, no more to take. Again, can't go below 0. Credit the Treasury stock at cost for $2,400. We have a balanced entry. Okay. They love to throw these in here just to reinforce that concept. So that's it for requirement 1. Requirement 2 is not too bad. They just want you, except for the writing part, they just want you to do the stockholders' equity section of the balance sheet. There are several of them within the chapter that they show you. The worst thing is the writing, but it's on the computer, so you won't have to do that. The paid-in capital section, and remember stockholders' equity has two components, paid-in capital, which is everything that's been contributed by your shareholders when they bought your stock. And also the second component is retained earnings, which is like the old capital account for 101. It's what's earned and that you don't pay back to your shareholders in the form of dividends. Dividends is just like the withdrawals in 101. It's withdrawals for many is what it's like. Okay. So we have our non-cumulative preferred, 103 par. This was authorized 2,600, 1050 issued and outstanding for 108, 150. Okay. When you multiply it out, the dividend could be expressed in percentage or a dollar amount per share or a percentage. This is more common, but there's also the dollar amount. They throw that in once in a while. And then the common stock, $1 par. Remember we had the split. 400,000 issued and 259.8 outstanding. Now, why is that? That's because we had 260, we bought back 1,000, right? So that would go down to 259, but then we reissued 800. So it goes back to 259, 800. We only kept 200 of the T stock. I call it T stock for short. I just made that up. It doesn't say that in any book. I call it that. So we have 259, 800 and issued and outstanding. And here's our 260 for our money. Total paid in capital 368, 150. A total of preferred and common. Here's our retained earnings balance, which they have in requirement 2. That's how come I know. It says retained earnings is $2,060,000. Okay. Assume that Dearborn. Okay, we have everything. Both common and preferred were issued at par. Okay. And then the last thing is the Treasury stock, which always gets subtracted after retained earnings. We have 200 shares at cost, that's $8, so it would be a minus of 1,600. Total stockholders' equity, $2,426,550. A lot easier because I pre-wrote it, but I thought I should go step by step because again, you have a similar problem to do in the homework, okay? So that's it for this one. I'll see you soon for the next one. Bye-bye.